Hello everyone, welcome to Daramola Talks Finance, and in today's episode of this video, I'll be talking about risks and how to be able to manage risks. I understand the fact that everybody is scared about risks. I don't like risks. I don't like taking risks. Anything that has to do with risks is not my thing. I understand, but you must know that risks is a part of life. And in today's video, we will be talking to you how you can be able to manage risks so you can be able to make effective investment decision, because risks is a part of life. All right, what you do for me is that you get a cup of tea like we always do, or some popcorn, then sit down with your writing material so you can learn and take action. Cheers. I said earlier, in today's video, we'll be talking about risks and how to manage risks so you can be able to take effective investment decision. Of a fact, a lot of us don't like risks. We don't like taking risks. Anything that is risky is not our thing. I also don't like risks, but you know what? If you want to make that effective decision, investment or any part of life, you know that risk is also something you have to put into perspective. But what you do with risks is more important than just avoiding risks, and that's what we are going to be dealing with in this video. So just a way of starting, what is risks? I'll try to be very plain here so I don't bug you with investment terminologies and all of that. But you must know that terminology is also very important because your word has power. But risks financially is a level of uncertainty on an expected outcome. In finance, is a level of uncertainty of an expected outcome. For instance, I invest in a particular business and I'm expecting to make 20% return on investment. There is a risk probability that I may make less than 20%. There's also a risk probability that I may lose my entire capital. And there's also a risk probability that I may make even above 20%. So you can see how it is. Your probability can be ahead of what you expect, can be below what you expect, and you can even lose your entire investment. That is risk for you. So now, if I may ask you, how do you manage risks? Because that's what is more important. How do you manage risks? And so I will be talking on some important terminologies here so I don't forget any point. So first of all, I want to talk about risks and returns. Risks and returns. Of a fact, I know that a lot of people say the level of risks will determine the level of returns you get on your investment, but that's not entirely true. And I want to clarify that, because some people say if an investment is risky, that means the return is also very good. No, that's not true. That may be a way to put you into a jeopardy, because there are some investment that is very volatile. For instance, cryptocurrency. I believe in cryptocurrency, but if you trade in cryptocurrency, it's very volatile. You can actually lose your entire capital if you don't know what you are doing. Now you get my point, right? If it is risky, you need to know what you're doing. If because it's risky and you want to make good returns and you just invest in it, you may end up being wiped out, and that will be some level of discouragement in your investment or financial journey. So risk and return on the other way around is also true, because the level of risk you take will determine the level of returns you are getting. For instance, a lot of people say that Warren Buffett is very wealthy, right? Okay, let me give you a scenario. For instance, I have a portfolio in Nigeria that has done about, I think it has done about 15% return on investment for like 2 years or something like that, like a portfolio of stocks. I'm just giving you a minimum amount. Now, Warren Buffett has made certain investment. Now, let's say that 15% return on investment that I've made generated, for instance, generated about 150,000 naira, right? Now, another person that has a billion naira, now I'm talking about Nigeria, for instance, a person that has 1 billion naira that makes the same 11% has a higher chance of return on investment. He's going to be making about 150 million naira. The same thing applies in dollars, the same thing applies in pounds. You get that point, right? So risks, it's variable. It's a function of your capital. So if you want to risk more, you have the chance to get more. If you want to risk less, you have the chance to get less. Now, someone that has $1 billion in his portfolio, he might make let's say 10% or 8% return on investment, that may amount to about $80 million or whatever that is in terms of the percentage returns. And someone that has $100,000 that makes 11% might not make up to what that person that has $1 billion that made 8% return on investment. So you can see, so you don't put yourself under pressure to feel as though you're not performing well because of your capital or because of the percentage you are getting. It's all variable, but you must understand that risks and returns is also related. The level of risks you make will determine the level of returns you get. So if you don't like taking risks, it means you should also put your mind in terms of you're not going to be making much returns because you're not risking more. If you like taking risks, then you can put your mind in terms of making good returns to get that reward for the risks that you are actually taking. So risks and hedge. Let's talk about risks and hedge. Now, if you Google a lot, just Google credit default swap. And why does bank love taking credit default swap? That's because bank lend money out to a lot of individual. Now, there's a percentage for a risk fall. It's called, I'm trying to remember the exact word now. It's called credit risk. Yeah, credit risk. Now, credit risk is the percentage or the probability that a borrower may not pay back what they borrow, or the person you give the mortgage to may not pay back. So as a way to compensate yourself, there's like an insurance you want to give to yourself. For instance, if my lender or my borrower doesn't pay back the money, I am still covered. So what do? I buy what is called a credit default swap. So I'm hedging myself with the probability that this guy borrowed this money may not return back the money to me. So banks, investment firms make this kind of investment decision. So why shouldn't you in terms of your investment? So you want to create hedge. You want to create hedge in your investment. For instance, some people say they want to invest in gold. So after they've done other investments, they want to also invest in gold for the sake of inflation, for the sake of volatility in the economy. So you want to look into that. What can I hedge against my risks so that I am safe? I'm talking about risks now. What can I hedge against my risks to make sure that I am safe? The next thing I want to talk about in that category is going to be different kinds of investment and their returns. I know I've mentioned a lot about investment saving accounts in this channel, so you can do it to watch my videos previously about investment saving accounts, indexes, and all of that. But now I want to give you an example, for instance, in terms of risks and returns. So if I'm investing, I invest in an investment savings account, I invest with Vanguard, I invest in Robinhood. I'm not telling you what to do, but I'm just telling you what I do. You get the point. So, and my portfolio it's a percentage of the level of my risk tolerance. For instance, high percentage of my investment is in shares, and a few percentage, if I don't think, I'm trying to be very, very correct now. A few percentage of my investment is in bond. A very few percentage of my investment is in bond. And the reason being is because I feel I have the age. I'm a bit younger, right? So if I have, let's say, 70 more years to live, you get the point. I have more longer time to live. So I can invest in risky assets. Now, if someone is in his 60s, 70s, approaching the age of retirement, he wouldn't want to be making such kind of a risky investment. So shares gives higher returns on investment than bond. I want high returns on investment, so I invest more in shares. And if you don't want to risk more, you just want something that your capital is preserved, then you should be looking at higher percentage in bonds. You get the point? So that's something I want you to look into. So if you're investing in an investment savings account, do you want a high returns on investment? If that's what you're looking at, then you should be looking at shares ISA. If you want a minimum return on investment because you want your capital to be safe, then you should be looking at bonds. You get that point? Now, the next thing I want to be talking about is margin of safety in terms of risks. So what is margin of safety? This will be like a concluding part. What is margin of safety? Margin of safety is an investment strategy whereby the investor buys an investment or an asset below its intrinsic value. So this is what I mean by that. You want to buy a property that is worth $450,000 or £450,000, and that's the value of that property. Now you negotiated the deal to the extent that you bought it 15% below the intrinsic value. Now that 15% is a margin of safety. That is why a lot of real estate investors will always say we make our profit when we buy the deal and not when we sell the deal. Because a lot of you may be saying, but my property appreciates in value. How do you know that the property appreciates in value? It's just your imagination. It's just your thoughts. It's just you just believing in theory. You watch YouTube and someone said the value of property increased. That's true. The value of property increased. But you don't know the value of your property until you sell it. In other words, let's say the valuators come and value your property. You bought this property for £450,000 or dollars, but now the property is now worth 600. Now, when it comes for you to sell it, the person that wants to buy the property can decide to want to negotiate the deal. And if you're under pressure, he may even want to sell it at 400. Remember, you're actually seeing your property values increasing. So you get the point. But when you buy the property below the market value, that's your margin of safety. If at all there's any risk attached to that property, you are covered. So in terms of real estate investment, what's not the margin of safety? Remember, we're talking about managing risks. It means you want to negotiate deals below the market value. It means you want to buy deals with a fair, good price, so that if at all there are any risks involved in it, you can be able to correct yourself. Now, what's the margin of safety? I've talked about investment in real estate. Now, for people that trade, for instance, you trade forex, you trade futures, indexes, you trade options and stocks and all of that investment. What's the margin of safety? What's your margin of safety in terms of that trading? This is the reason why they say when you want to make a trading decision, you want to look at the returns. So I want to risk 1 to get 3. So in other words, I'm risking 1 with the percentage that will get 3. So for you to lose your capital, you need to lose 3 to lose your capital. Now let me explain myself. If I'm risking 1 to get 3 and I took a first trade and I got that trade right, so I've made 3 already. So if I take the next trade and I lose, I still have 2 left. If I take the next trade and I lose, I still have 1 left. If I take the next trade and I lose, then I've lost my profit. So you can see, I need to have lost 3 times before I lose my profit. But my capital is still preserved, because if you have £10 or $10 as an investment capital for trading, and you made 3 times of that money, in other words, you made 10, 10, 10. That means you've made 40 in total, right? Now, if the first one you lose 1, you've lost 10. You mean you're having 3, you're having 30 left. If you lose on that one, you're having 20 left. If you lose on that one, you have 10 left. You get the point? So you still have your capital preserved. But if you're trading and it's 1-to-1, if you lose 1, you have lost your capital. If you lose 2, you have lost your capital and you are even under credit. So I want you to understand this time that when you want to make a trading decision, at least it should be 1:2. So if you are risking 1, you want to get 2. If you are risking 1, you want to get 3. If you are risking 1, you want to get 4. If you are risking 1, you want to get 5. Right? So that's your margin of safety. Now, for gold investment, I've mentioned it earlier. This is like an ancient investment for a lot of wealthy people. So they have a particular portion of their money that is in gold, commodities. It doesn't give good returns, but it's an hedge. It protects them because it's not volatile. Your money is always preserved with gold. And there's a lot of tax benefits. And if you want me to talk about gold investment and tax benefits, specifically if you're in the UK, just give a comment and I'm going to be explaining how you can invest in gold and the tax benefits. Now the next is buying a business. The same thing applies in real estate. You want to negotiate below the intrinsic value so that you can cover the sake of uncertainty that may occur in the business. If you bought it cheap, you can say, well, I bought it below the market value, so this percentage will cover for the risks that may be involved in the business. And last but not the least is knowledge. Knowledge. Risk is also synonymous or related to knowledge. If you want to take any risky investment or any investment that has to do with risks, make sure you understand what you're doing. That include those that trade cryptocurrency, or you trade forex, or you trade indexes, you trade futures, you trade options, you trade binary, or whatever you trade. You make sure you have the knowledge of what you are doing. You trade shares, make sure you have the knowledge, the technical, the fundamental, the psychological qualities that is involved in making those trade decisions. You want to buy a property, you have an understanding of the kind of property you want to buy. Is it HMO? Is it buy to let? Is it BRRR? You just need to understand what you are doing. That will help you know the level of risks you are taking before you dip your leg into the water. So you don't just take risks for the sake of taking risks because you want to make good returns. You have to understand what you're doing. Remember, the goal is that we always stay green, not staying red. Red means you're losing money, green means you're making profit, right? All right, thank you very much. So if you've learned something from this channel, please just like, share, and subscribe, and give your comment. If you have any question, also give your comment, because that will direct us on the kind of videos we'll be making the next time you see our videos. And also click on the notification bell, share this video. There may be somebody that wants to make a risky investment. Let them watch this and it's going to bless them. Cheers. Thank you guys for watching, and see you the next time. Bye for now, and always stay green.